The SEC just approved a groundbreaking set of rules, forcing public companies to disclose the carbon emissions associated with their operations by 2026. In this video, we'll discuss what this means and how it impacts companies in the US, as well as your investments in the stock market. So the SEC has decided to force public companies in the US to disclose a variety of climate-related risks and mitigation efforts. Keep in mind, companies have the freedom to decide what is material enough to disclose, and smaller companies don't need to worry about reporting their emissions. This is determined by a company's filing status with the SEC. For a large accelerated filer, or LAF, who have a public float worth more than $700 million, filing will start primarily in 2026. An accelerated filer, or AF, with a public float worth $250 million and above, will start filing in 2028. And lastly, the smaller companies, aka microcaps, with public floats worth less than $250 million, won't have to file any disclosures for their Scope 1 and 2 emissions. We'll go over what the different scopes of emissions are in a bit. But let's review all the disclosures the SEC is set to require. They include reporting any climate-related risks that may have a material impact on a business's strategy or operations, the company's process for identifying those risks, if any actions that are currently being taken to materially avoid those risks, what a company's climate targets or goals are, potential costs or risks from natural disasters or other weather events, and most importantly, larger companies are now required to disclose their Scope 1 and 2 carbon emissions, as we mentioned a minute ago. Scope 1 emissions are directly from a company's operations, and Scope 2 are from the energy sources the company uses. A major point of contention from the SEC was whether or not they would include Scope 3, which includes all indirect emissions from customers or suppliers and so on. So this encompasses the entire value chain of a company. In the end, the SEC chose not to include Scope 3, so only Scopes 1 and 2 will be required disclosures for public firms. As many news publications have noted, Scope 3 emissions can often make up the majority of emissions a company creates. They're indirect. So the SEC certainly watered down how intensive these new regulations were going to be. The SEC justified requiring climate disclosures by claiming climate change is a tangible risk that needs to be addressed by public companies. If an investment could be impacted by the level of emissions a company produces, then that needs to be made clear to any potential investor. Given this reasoning, I don't really see how people can argue that the SEC is overstepping its legal authority. The SEC is an organization dedicated to providing investors with as much information as possible. Yeah, that's the whole goal. They even removed the requirement to disclose Scope 3 emissions to try to avoid legal challenges. But that isn't stopping more Republican states from challenging this ruling, though. So far, 10 states have formed a coalition to challenge the SEC on these regulations. So we'll ultimately see what happens in the courts and if this ruling is upheld. Funnily enough, more left-leaning organizations might sue the SEC as well. Environmental groups like Sierra Club and Earth Justice are also considering challenging the removal of a requirement for Scope 3 emissions. So the right is upset with the SEC for going too far, and the left is upset with the SEC for not going far enough. There really wasn't a winning here for the SEC. They likely decided they could only get away with Scopes 1 and 2. And the fact of the matter is, the United States has a massive fossil fuel industry with lobbying capabilities to sway things. Either way, a win is a win. Even without Scope 3 inclusion, this is still a step in the right direction. So the real question is, how does this actually impact investors? What does this mean for the public companies? Well, for starters, it could certainly be costly trying to calculate all the emissions a company is associated with producing, especially if the SEC were to mandate the disclosure of Scope 3 emissions later on. So there will be additional costs associated with this ruling for public companies. Secondly, this provides a lot of potential firepower for environmentalist groups to use against these public firms. If a company has to lay out what they've done to mitigate climate-related risks, and at least what their direct emissions are, there's a lot more pressure for them to take action. It will be increasingly obvious when a company is not following through on any of its climate goals that they've declared in the past, and we're moving closer and closer to a world where carbon emissions are considered a genuine liability for these companies. In turn, this makes it more likely that companies will take actions to offset their emissions. A direct way to benefit from this trend, not only in the United States but around the world, is to invest in green companies, the focus of this channel. Businesses offering solutions like carbon credits, carbon capture, electric vehicles, the list goes on. There are a variety of ways you can invest in the decarbonization trend, and all these companies are set to benefit from the spotlight placed on carbon emissions. I recently put out a post on Substack about the financial incentives behind the energy transition, link in the description. In that post, I go over a variety of ways that governments and corporations are using financial incentives to move the markets in a greener direction, making it financially viable to begin transitioning to a net zero economy. This includes emissions trading systems, which are cap and trade schemes that determine a carbon price with a cap on carbon emissions. There's also carbon taxes, carbon tariffs, green bonds, as well as other forms of subsidies for projects that contribute to the energy transition. These are all the financial forces that are pushing companies to move green. As I mentioned on Substack, the forces calling for environmental efforts from these public companies are only growing around the globe. The EU is the furthest along, enforcing an emissions trading system, carbon tariffs and more. We've seen positive impacts from the Inflation Reduction Act in the US, providing a variety of financial incentives. Canada has a carbon tax. The BRICS nations like China, India, and Brazil are all launching their own emissions trading systems, so their energy sectors will need to start searching for ways to reduce their emissions as well. That's just a small list of things that have been progressing, especially over the last few years. Even if it doesn't seem like it at times, progress is being made around the world. Now, will it be enough to limit warming? Well, that's a whole different question entirely. But regardless, we have the culmination of both financial incentives that are only growing in popularity, primarily being pushed by governments to make technologies viable to scale. And we also have social pressures from environmentalist groups and the general populations in most countries that believe in climate change. Disclosing a company's carbon emissions only contributes to the calls for action. It will be increasingly difficult for companies to justify doing nothing or trying to greenwash. In this same vein of reasoning, just as the popularity of combating climate change grows, so does the investment attractiveness of green industries. There are a number of tailwinds all moving in one direction. As I mentioned earlier, carbon credits, carbon capture, plastic recycling, these are some of the less popular sectors to focus on when investing in the green transition. And finding those undiscovered or underappreciated investment options is what my channel, Green Investing, is dedicated to. If you're interested in hearing more about these opportunities, then you can check out my YouTube channel, and I also post on X and Substack as well. Links in the description. Thanks for watching.